Hello everyone, welcome to the market opening bell on Thursday, July 3rd, your 10-minute guide to the stock market. Hong Kong stocks started the second half of the year on an upward note. The Hang Seng Index opened 232 points higher, briefly climbing 300 points to a high of 24,372 before gains narrowed. It closed up 149 points or 0.6% at 24,221. The X-share index rose 46 points or 0.5% to 8,724, while the Hang Seng Tech Index fell 33 points or 0.6% to 5,269. Total market turnover was 240.2 billion Hong Kong dollars. Southbound trading turnover reached 128.9 billion Hong Kong dollars, with southbound funds recording a net inflow of 5.036 billion dollars. Notably, net buys tracker fund totaling 1.674 billion, Innovent Biologics 651 million, Meituan 338 million, SMIC 317 million, Chongqing Iron and Steel 144 million, PopMart 122 million, 3S Bao 109 million. Net sales Alibaba 1.734 billion, Tencent 629 million, Xiaomi 369 million. Statistics show southbound funds have net sold Tencent for 23 consecutive days, totaling 22.524 billion Hong Kong dollars. Xiaomi for 3 days totaling 3.735 billion. Alibaba for 3 days totaling 3.082 billion, and net bought SMIC for 9 days totaling $5.943 billion. Technically, the Hang Seng Index remains capped by the 24,400 to 24,500 resistance zone. The 10-day and 20-day moving averages are approaching 24,000. If this level is breached, the index may retreat to fill the June 24th upward gap, spanning 144 points between 23,689 and 23,833. Mainland Chinese markets opened high but closed lower. The Shanghai Composite Index peaked at 3,461 but closed at 3,454, down 3 points or 0.1%. The Shenzhen Component Index hit 10,455 but closed at 10,412, down 64 points or 0.6%. Combined turnover for both markets was 1.3769 trillion yuan. The renminbi central parity rate was 7.1546 to 1 US dollar, down 12 pips from the previous day. Benefiting from easing US-China tariff tensions, the June Caixin China manufacturing PMI rose to 50.4, returning to expansion territory, surpassing market expectations and up 2.1 points from May, matching April's level. Caixin Insight Group senior economist Wang Zhe noted that the external environment remains complex with rising uncertainties, while insufficient domestic demand persists. Recent macroeconomic indicators show divergence, with some consumption sectors exceeding expectations, but industrial production and investment growth have weakened, and market optimism remains subdued. Long-term consumption momentum should focus on job security, stabilizing expectations, and increasing income. Anticipation of reduced mainland photovoltaic glass production lifted stocks like Flat Glass and Xinyi Solar, both up over 10%. On July 1st, President Xi Jinping held a meeting emphasizing legal measures against low-priced, disorderly competition, urging firms to improve product quality and phase out outdated capacity in an orderly manner, while standardizing government procurement and bidding. State media People's Daily recently criticized excessive competition in the solar industry, advocating for high-quality development. A Shanghai non-ferrous metals market report stated that some domestic solar glass producers plan to cut production by 30% from July 2 to 5. Photovoltaic glass has faced 8 consecutive weeks of gross margin losses. Industry insiders believe production cuts could help clear inventories and align production with sales. The sector may see large-scale reductions in the second half, with daily melting capacity potentially dropping to around 90,000 tons by year-end. Historically, photovoltaic glass stocks have rallied on production cut news, but gains often fizzled due to persistent overcapacity. However, this time surging turnover and new yearly highs suggest stronger investor confidence, potentially sustaining the rally longer than in the past. Automakers reported June sales. BYD sold 382,000 units, up 12% year-on-year, but flat month-on-month, with its stock down 0.2%. Leapmotor hit a record 48,000 units, up 138% year-on-year, with its stock up 0.5%. Li Auto, which previously lowered Q2 delivery targets, delivered 36,279 units, down 24% year-on-year and 11.2% month-on-month, with its stock falling 3.2%. XPeng delivered 34,600 units, up 224% year-on-year, marking 8 consecutive months above 30,000 units, with its stock up 2.2%. NIO delivered 24,925 units, up 17.5%, both year-on-year and month-on-month, but its stock fell 2.2%. Xiaomi delivered over 25,000 units, with its stock up 0.3%. Geely sold 236,000 units in June, up 42% year-on-year, with its stock rising 2.3%. In the first half of 2025, Geely's cumulative sales reached 1.4092 million units, up 47% year-on-year. The Geely Galaxy brand, originally a mid to high-end new energy vehicle lineup, has become an independent brand and was the biggest contributor, delivering 548,400 units in the first half, up 232% year-on-year. Zeekr delivered 43,012 units in June, marking its fourth consecutive month above 40,000 units, with Zeekr brand sales at 16,702 units and Lynk & Co at 26,310 units. On Tuesday evening, Geely raised its annual sales target from 2.71 million to 3 million units, a surprising move amid slowing growth in China's auto market and downward revisions by other automakers. The newly listed stock, Cowblick Pharma, closed at 10.6 Hong Kong dollars in Philip Mart's grey market, up 5% or 0.5 Hong Kong dollars from its IPO price. Excluding fees, a 500 share lot would yield a paper profit of 250 Hong Kong dollars. U.S. employment data significantly underperformed expectations, boosting hopes for interest rate cuts, while positive trade negotiation signals further supported markets. The S&P 500 and Nasdaq hit new all-time highs. The Dow Jones Industrial Average closed down 10 points or 0.02% at 44,484. The S&P 500 rose 29 points or 0.5% to 6,227. The Nasdaq gained 190 points or 0.94% to 20,393. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, rose 4 points to 7,358. Tesla reported Q2 vehicle deliveries of 384,100 units, slightly below the market's expected 387,000, down 13.5% year-on-year, marking a second consecutive quarter of decline. Data from China's PCA showed Tesla's China-made EV sales in June reached 71,600 units, up 0.8% year-on-year, ending an 8-month decline streak and up 16.1% month-on-month. Easing concerns about a sharp sales drop, Tesla stock surged nearly 5%. Other tech stocks were mixed. Nvidia rose 2.6%. Apple 2.2%, Alphabet 1.6%, while Microsoft fell 0.2% after confirming layoffs of up to 9,000 employees, about 4% of its global workforce, the largest single cut since 2023, affecting cloud services and some emerging project reorganizations. Amazon dipped 0.24% and Meta fell 0.8%. The June ADP private payrolls report showed a 33,000 job loss, far below the expected 95,000 job gain, marking the first decline since March 2023. May's data was also sharply revised down to a 29,000 gain, influenced by the data. Federal funds futures indicate a 27% probability of a July rate cut, with at least one cut by September nearly certain, and a 22% chance of a 50 basis point cut. Additionally, according to Challenger, Gray and Christmas, U.S. employees announced 47,999 job cuts in June, the lowest this year, compared to 93,816 in May and 48,786 a year ago. Q2 saw 247,300 job cuts, the highest Q2 total since 2020. Year to date, 744,300 job cuts have been announced, the highest since 2020. Retail led private sector cuts with 79,865 jobs lost, impacted by tariffs, inflation, and uncertainty. The U.S. June non-farm payrolls data, due tonight, which is Thursday U.S. Eastern Time, could solidify expectations for a Federal Reserve rate cut as early as late July if it continues ADP's weak trend. Our stock pick today is OrbusNeich Medical, stock code 6929. OrbusNeich Medical is a leading global medical device manufacturer specializing in interventional devices for PCI and PTA procedures. Its products are sold in over 70 countries and regions worldwide, with a product portfolio covering all major therapeutic processes in PCI and PTA surgeries, including lesion access, lesion preparation, lesion treatment, and lesion optimization. The portfolio includes semi-compliant balloons and scoring balloons for predilation and lesion preparation, stents for implantation, non-compliant balloons for post-dilation, and specialized catheters. The group is also actively expanding its business into neurovascular interventions and structural heart disease areas. In 2024, the group achieved sales of 1.7 million units, of which 1.5 million were proprietary products, representing a year-on-year increase of 4.8%. The group recorded revenue of $164 million, up 6.6%. By region, revenue from the Asia Pacific market reached $52.2 million, surging 43.7%, primarily driven by external growth of $11.5 million from newly acquired distributors in Indonesia and South Korea, as well as strong organic growth of 13.8% from markets such as Malaysia, Singapore, Hong Kong, Vietnam, and India. Notably, the latest generation scoring balloon, Scoreflex Trio, saw rapidly rising sales following its launch in Malaysia in early 2024. Revenue from Europe, the Middle East, and Africa grew 7.9% to $39.2 million, mainly due to increased sales of proprietary balloon products in direct markets, example Germany and Spain, and distribution markets, example Czech Republic, Slovakia, and the UK. Revenue from Japan was $34.4 million, down 9.4%, primarily due to the continued depreciation of the yen against the dollar throughout the year and periodic reimbursement price reductions in the second half. Revenue from mainland China was $20.7 million, benefiting from the progressive implementation of the 3+N alliance volume-based procurement in the Beijing, Tianjin, Hubei region and other provinces, as well as the group's more proactive marketing strategies, which drove strong sales growth for Scoreflex. Revenue from the US market was 17.5 million US dollars, primarily driven by adjustments to sales strategies with US distributor Abbott, with sales of the high average selling price product Scoreflex NC in the second half exceeding 3 times those in the first half. The group's annual profit attributable to shareholders decreased 11.9% year-on-year to 39.7 million US dollars, mainly due to significant integration efforts following the acquisition of 3 companies at the end of 2023, which incurred additional operating expenses of 9.5 million US dollars. Looking ahead to 2025, the group expects continued revenue growth from the Asia Pacific and Europe, Middle East and Asia and Africa regions, with the US market also maintaining its recovery momentum. In mainland China, the group's multi-generation product offerings enable greater flexibility in participating in volume-based procurement. Additionally, the group is poised to launch new products, including Teleport Glide and Scoreflex Quad, to expand its product portfolio, initially targeting the Japanese market. In recent years, regulatory changes in mainland China and international markets have posed challenges for medical device developers and manufacturers, particularly the transition from the EU Medical Device Directive (MDD) to the EU Medical Device Regulation (MDR) and China's volume-based procurement program. The group views the current environment as a golden opportunity for mergers and acquisitions. As of December 31st, 2024, its cash and bank balances stood at 248.6 million US dollars. With ample financial resources, the group is well positioned to seize industry consolidation opportunities, accelerate enhancements to its technology, research and product portfolio, and actively seek suitable downstream businesses to further strengthen its overseas sales network. Recommended buy price 3.95 Hong Kong dollars, target price $4.35, stop loss $3.75. I do not hold the aforementioned stock.